Did you know that a company actively projecting $200 million in full-year revenue just reported a quarterly actual of only $3,400,000? That is an 85% miss compared to what Wall Street estimated. If you clicked on this video because you wanted to know what everyone is missing about DVLT stock and whether it is truly about to explode, you are in the right place. My name is Calvin Mateo, and today we are tearing apart the bizarre reality of Datavault AI, ticker symbol DVLT, piece by piece. At first glance, this company sounds like the future. They are promising a revolution in Web 3.0, AI-driven tokenization, and edge computing. But right now, we are looking at one of the most extreme paradoxes in the entire stock market. Management continues to pump out billion-dollar headlines while the market reality is severely depressed. Retail investors are screaming for a short squeeze, but what we are actually witnessing is a phenomenon called PR exhaustion. The market has stopped blindly buying the hype, and institutional investors are now demanding cold, hard, audited revenue. While these growth projections look incredible on paper, there is one specific, hidden metric we will look at in a moment that completely changes how you have to trade this stock. Before we go any further, if you appreciate deep dives like this that go beyond the surface level hype, do me a quick favor and smash that like button and subscribe to the channel so you never miss an analysis from Calvin Mateo. Now, let me show you what is really going on here. But that is only half the story. Take a look at the recent price action and you will see exactly what PR exhaustion looks like in real time. On July 31st, 2026, the stock closed at an incredibly weak 34 cents. We did see a temporary spike up to 38 cents late in the month when the company announced the deployment of its massive Project Questral GPU fleet. Normally, an AI hardware deployment announcement sends a tech stock soaring, but for Datavault, the surge was instantly rejected and the price completely retraced right back down. Why? Because the downward pressure pushing this stock into the dirt is not about the technology, it is about mathematical exhaustion. No matter how good the news is, the stock just bleeds. If we dig deeper into the actual numbers, the answer to that constant downward bleed is sitting right here in the share structure. Datavault is suffocating under its own weight. The company's outstanding share count has absolutely exploded to over 573 million shares. That leaves the market dealing with a bloated public float of 535 million shares. For those newer to market mechanics, the float is the number of shares actually available for the public to trade. When your float is this massive, it acts like a giant wet blanket. It creates a structural overhead resistance that instantly smothers any upward momentum. And to make matters worse, to cover their immediate merger costs, the company just took on a toxic $833,000 bridge loan featuring a 10% discount and a punishing 13% interest rate. That is the kind of financing that should make any investor raise an eyebrow. When you pair that massive supply of shares with the current technical chart, things look even more concerning. Technically speaking, DVLT is trapped in a prevailing bearish nightmare. We recently witnessed a confirmed death cross. In technical analysis, a death cross happens when a short-term moving average crosses below a long-term moving average. Right now, the 50-day average is sitting at 39 cents, completely trapped below the 200-day average at 92 cents. Furthermore, the MACD indicator is flashing sustained bearish signals, and the Relative Strength Index, or RSI, is sitting at roughly 42. This is crucial because an RSI of 42 is considered neutral. It means that despite dropping to 34 cents, the stock is not yet technically oversold. There could still be more room to fall. Could we actually see this stock dip below 25 cents before any recovery begins? It is not out of the question. But while this looks like a textbook death spiral, this exact technical trap is creating a very unique opportunity that we will look at in just a few minutes. But before we get to the upside, we have to look at what the analysts are doing. Wall Street coverage on this stock is dangerously scarce, which immediately elevates your risk profile. The primary coverage comes from Maxim Group, who does maintain a buy rating. However, they recently slashed their price target from $4 down to $3. Now do not get me wrong, a $3 target on a 34-cent stock is still an explosive 800% upside, but you have to pay attention to why they cut the target. Maxim analysts explicitly stated that the downgrade was a direct result of the ongoing severe equity dilution we just talked about. They love the intellectual property portfolio, they love the tokenization pipeline, but the sheer volume of shares being printed is destroying shareholder value. So here is the question that should be nagging at you right now. If Maxim Group, the one firm actually covering this stock, is slashing their target because of dilution, what happens if the company authorizes even more shares? Could the remaining institutional coverage disappear entirely? And that brings us to an even bigger red flag hiding in the institutional filings. If you want to know what is really happening with a company, you follow the smart money. In Q4 of 2025, there was massive institutional accumulation. Vanguard and State Street increased their stakes by over 2,800%. Retail investors cheered. But fast forward to Q1 of 2026, and we saw a violent total reversal. State Street aggressively slashed its position by 85%, dumping 8.7 million shares onto the open market. Jane Street was even more ruthless, completely liquidating their entire position and dumping 4.5 million shares. The smart money did not just trim their positions, they sprinted for the exit. And that raises a deeply uncomfortable question. What did those institutional desks see in their due diligence that retail traders scrolling social media simply did not? Is it possible the next quarterly filing reveals something even worse than what we already know? If the smart money leaving was not enough to make you pause, let us look at the people running the company. Over the last 6 months, there have been exactly 0 open market purchases by corporate insiders. Not a single executive has reached into their own wallet to buy shares at these depressed prices. On the flip side, we have seen 20 massive insider sales. Major shareholder Vivasor dumped 20 million shares, pulling over $11 million out of the stock. Celex unloaded over 31 million shares, cashing out $32 million. Even the CEO sold off 285,000 shares. The only acquisitions we have seen from insiders recently were 250,000 share equity grants awarded to board directors for free as compensation. Insiders are treating this stock like an ATM, while retail is left holding the bag. Think about that for a second. If the people who know this company better than anyone on the planet are not buying at 34 cents, what does that tell you about their confidence in their own projections? Now, none of this matters if we do not look at the risks looming in the background. Datavault is currently fighting a multi-front war. First, they are facing active probes from shareholder rights law firms like Johnson Fistel and Robbins LLP. These investigations stem directly from a devastating Wolfpack research report that accused the company of being a stock promotion scheme built on empty AI claims. Second, there is a ticking time bomb regarding compliance. The stock has an imminent August deadline to regain the $1 minimum bid price to avoid being delisted from the NASDAQ. If they cannot get the price up organically, they will be forced into a reverse stock split, which historically triggers aggressive waves of new short selling. What if both the legal probes and a forced reverse split land in the same quarter? Could that kind of compounding pressure push the stock below 10 cents? It is a scenario most bulls refuse to even consider. With all this doom and gloom, you would think this stock is completely dead. But there is one hidden metric here that flips the script entirely, which leads us to the structural squeeze fuel, and this is why you cannot just write this stock off. As of mid-July, there are 96.44 million shares currently sold short. That is over 12.2% of the entire public float betting against the company. But the most critical number here is the days to cover ratio, which is sitting dangerously high at 3.9 days. Days to cover simply means that if every single short seller decided to buy back their shares to close their position based on average daily volume, it would take them almost 4 full days of non-stop buying to get out. That creates massive friction. Because we do not have clear options chain data available for Datavault, volatility predictions have to rely strictly on this massive equity short interest. It is a coiled spring, and here is the question the bears do not want to answer. What happens if a single piece of verifiable, undeniable good news drops while nearly 100 million shares are sold short, with almost 4 days of covering needed? The math gets violent very quickly. So, how does a company with this much short interest actually trigger a squeeze? To force a short squeeze, you need an undeniable catalyst, and Datavault has several major sparks lined up. First, they are finalizing their acquisition of NYIAX, which is a desperate but critical attempt to boost recognized revenue in Q3. They have also signed a letter of intent to acquire CyberCatch to expand into quantum-resistant cybersecurity, but the biggest catalysts are on the calendar right now. We are looking for any PR regarding the $2 billion Helmex financing deal, and most importantly, August 19th, 2026 is their Q2 earnings call. If they can provide tangible, GAAP-audited proof that their $800 million in signed tokenization contracts is actually generating cash, that is the spark that blows up the short sellers. But what if that earnings call comes and goes with more vague projections and zero verifiable revenue recognition? What if the Helmex deal quietly fades into another press release with no substance? That is the knife's edge this entire thesis sits on. So, what is all this actually worth? Let us deliver the strategic verdict. For a traditional, long-term institutional investor, DVLT presents unacceptable fundamental risk. Between the massive float dilution, the aggressive insider dumping, and the pending legal investigations, this company is fundamentally uninvestable as a core buy-and-hold portfolio asset right now. You cannot lock your money up in a company facing this much structural headwind. However, and this is the part most analysts will not tell you, these exact same chaotic conditions, the beaten down price, the massive short interest, and the looming catalysts have created a highly localized, incredibly lucrative speculative technical environment. The chaos itself is the opportunity, but only if you know exactly how to structure the trade and protect your capital. Here is exactly how we are setting this up for the week. This is a short-term, highly speculative long setup designed to capitalize on range-bound mean reversion and squeeze mechanics between August 1st and August 6th. The stock has established a historical floor near a psychological support zone. Your entry price zone is right here between 30 cents and 32 cents. Your first profit target, where you take some risk off the table, is 38 cents, which aligns with the late July pivot high. Your primary profit target is between 42 and 43 cents, which perfectly aligns with the heavy technical resistance of the 50-day moving average. It is a clean, asymmetric setup with fantastic upside potential if the earnings run-up begins. But executing this requires absolute discipline, and this is the part that separates traders who survive from traders who blow up their accounts. Because we are flying blind without options chain data to structure a defined risk collar, your capital protection relies entirely on strict, ruthless discipline. When you enter in the low 30-cent range, you are getting incredibly tight risk against the established floor. Your hard stop loss is set firmly at 24 cents. A daily close below that 52-week low completely invalidates the technical thesis, and you must exit the trade immediately to protect yourself against sudden dilution announcements. You are exploiting the 12% short interest. Any unexpected positive PR leak regarding the Helmex financing or an earnings surprise into this tightly wound structure will force rapid involuntary short covering toward our 42-cent target. Manage your risk, respect your stop loss, trade the setup, not your emotions. Now, before I let you go, I have to be completely transparent with you. Nothing in this video constitutes financial advice. I am not a licensed financial advisor, and this content is for educational and entertainment purposes only. Every trade carries risk, and you could lose some or all of your invested capital. Always do your own due diligence, consult with a qualified financial professional before making any investment decisions, and never trade with money you cannot afford to lose. Past performance and technical setups do not guarantee future results. With that said, here is my final take for you. Datavault AI is not a stock you fall in love with. It is not a stock you diamond hand into oblivion hoping management delivers on their billion-dollar dreams. It is a stock you trade surgically with a defined plan, a hard stop, and the discipline to walk away when the setup breaks. The short interest is real, the catalysts are on the calendar, and the technical compression is undeniable. But so is the dilution, the insider selling, and the legal overhang. Your edge comes from respecting both sides of that equation. Now I want to hear from you. Drop a comment below and tell me, do you think Datavault can actually deliver audited revenue on that August 19th earnings call? Or is this just another round of press release theatre? I read every single comment, and I genuinely want to know where you stand on this one. If you got value from this deep dive, hit that like button, and if you are not already subscribed to Calvin Mateo, now is the time. We break down these high-risk, high-reward setups every single week, so you never walk into a trade blind. I will see you in the next one.